You're watching Beyond Market. Welcome, I'm Esther Awuni. Many thanks for joining us. On today's show, we'll explore the World Bank Group's new approach to finance for development with International Finance Corporation's Vice President for Economics and Private Sector Development. You can join today's conversation with the hashtag Beyond Market, and you can send your thoughts or your comments to my Twitter handle too. It's at Esther O. Awuni. The World Bank is exploring a new approach to development finance called Maximising Finance for Development. This, it says, will help poor countries unlock more private sector capital. Hence, Peter Lankes, IFC's Vice President for Economics and Private Sector Development, joins me today to share more insight on this. So let's talk about this new approach. I mean, obviously, the World Bank, through its other arms like the IFC, have helped to bring in attract private capital, helped provide regulatory assistance and all kinds of assistance to developing countries, especially the poorest of the lot. I'm just wondering why this sudden change in approach. Obviously, it's all about bringing in more private capital. I'm just wondering why this difference, why this change in approach?
Thanks for having me here first, Esther. I think it's always a pleasure to be at CNBC.
Okay, thank you.
It is not really a new approach. It's not a change in approach. It is something that the World Bank Group has been doing in many ways for a very long time, bringing in the private sector into the development game.
Okay.
But we want to take it a big step up, make it much more systematic, make it sort of a foundation for the way that the World Bank Group works.
Okay.
And in fact, it's how we believe the whole development finance community needs to work. And the reason is that the task is just too big for the public sector to deliver. We have the Sustainable Development Goals as an international community. We agreed that by 2030 we want to make a huge amount of progress. And if you calculate what that takes, it is way beyond the capacity of public sector budgets. You take virtually any country and you will find that the fiscal space is limited. And what needs to be done in infrastructure, from power to fiber to any kind of infrastructure you might think of, but also in the health care and the educational area and in general industry, is just far beyond the public sector's reach. And if you go back several decades, development, the mindset around development was public sector driven. And that was true around the globe. Okay. That began to change in the 80s, 1980s, and where the private sector began to be a more important force. And it changed radically in the 1990s and the 2000s, where the private sector, private funding, private capital flows into emerging markets and developing countries came to dominate. And today, there is far more private capital going into development investment, development relevant investments, than there is public money. So we just need to make it work in the best way for development. And an institution like the World Bank Group has to ask itself, so if there's this task here at hand, is this something that we need the very scarce public money for, or could that be done by the private sector? If it can be done by the private sector, it should, because the public money is necessary in areas in which the private sector cannot come in. If you think about rural roads, if you think about much of primary education, all the trade-offs that governments face, you need public money. So don't use it for things that the private sector can do very well. Okay. So that has changed. And because the private sector so is able to do it, we now have a whole range of experiences from across the world how to do it well. And that is where we want to get. We want to work with the private sector in a way that it solves development problems, but that does it well.
Okay. Now for the private, because at the end of the day, yes, it's been identified for a while now that it's private sector money that's going to move the needle. Even governments, even in the poorest countries, know that their budgets are limited, resources, even those with commodities, raw commodities, they know that at the end of the day, the resources for them are limited. But there are still barriers, even for the private sector themselves, for private sector money to come in. Some of these countries are so poor that they do not even have the right institutions or even markets to allow this private sector capital to come in. And I know that that is something, obviously, the World Bank and the IFC bringing in that kind of expertise, but how is that going to work now? Is there a more coordinated approach now to position not just developing countries, but the poorest of the lot? You know, I keep emphasizing on that, you know, especially here on the continent, those that do not have the markets and institutions, and at the same time, on the other hand, providing instruments that de-risk or, you know, help investors put their minds when it comes to risk, because at the end of the day, the investors, they need to know that their capital is going to, you know, bring in returns while also impacting on lives. So back to my question, what is that coordinated approach now?
Yes, and that's a very good question, and it's particularly a good question for countries with limited capacity. So if we look today at Southeast Asia, or we look at Brazil, or a variety of emerging markets, the private sector, it's very natural for the private sector to finance the power sector, and to finance you know, the telecom sector. Nobody really asks that question anymore. That is what's happening. And you're right, it is happening because in those environments, the conditions are right for the private sector to do that. In many parts of Africa and some other parts of the globe, it is still more difficult. And it's more difficult because of weaknesses in the institutional environment, because of perceived risks. So we need to work on that. So the mere, so what I was saying before, under maximizing finance for development, we asked this question. We call it the cascade. Is this something that could be financed by the private sector? Well, the next question has to be, is the environment right for the private sector? And if it's not, can we do something about that environment? And only if we feel that we cannot do anything about the environment, then we move to public solutions. So that middle bit, the private sector would, in principle, be able to solve this development problem, but it doesn't because of obstacles, because the legal framework is faulty, or because there's a bad history of interventions and the private sector got its fingers burned. That is what we have to tackle. And we have built a range of instruments to do this better. So one instrument is that we now work very naturally across the World Bank Group. We have our private sector oriented institution, that's the IFC. And we have the public sector, the World Bank proper, and IDA, which is the concessional finance part of the World Bank, that are working in the public sector. We can work with them to help the public sector make it possible for the private sector to come in. So take the context of PPPs in the power sector. You go back in history, there have been quite a few mistakes made in that field, and including here in Nigeria. So we need to really draw on these experiences and do it better. That is something that our public sector arm can do. It can build on best practices, work with the authorities to establish a good PPP framework, say, and then have open and transparent tenders for the private sector to come in. This is now routine in many parts of the world. We need to bring that into Africa. We need to bring that into the more difficult environments. But it's possible. That's the point if we approach it in a very systematic way.
For the public-private partnerships, and I'm happy you mentioned Nigeria, because I've had several conversations with analysts and even the public sector, especially power. Obviously, you're aware of the privatization exercises that we've had here, and aviation and some other sectors where PPP was put in place and it just didn't work. And we kept going back and forth on conversations about what the right model for the PPP would be, what is the role of the government, what is the role of the investor coming in, and what are those bottlenecks, legal or otherwise, that continue to stand as barriers in a way of a good PPP. So I'm just wondering, what would change? What do you see those mistakes that keep happening here, why those PPP models do not work?
Well, there are many different circumstances. Every PPP, every sector has its own specificities. So there's not one model. But there are, at the core of it, you have to find a sensible distribution of the risks. What risk is the public sector taking in a PPP? What risk is the private sector taking? We had a very interesting workshop in Abuja earlier this week with public sector, with private sector, discussing these issues, and there's a lot that surfaced. One thing I'm impressed with here in Nigeria is the openness and the forthrightness of the debate, and it all came out. What had gone wrong, what can be done better. So it is about that balance between on the risks, and here there are clearly examples. If you take the power sector, in which the public sector ended up with the bill, it could have been structured in a way up front that might have minimized that particular risk. So you need to look at the specific circumstances. But ranging from solar in India, in Argentina, to the way that broadband is being rolled out in many countries, you have models in which this works, in which it is clearly where we now, if you want to have the experience and the technology to design it well, and we can design it well in Nigeria. If you look across the border in Cameroon, IFC and many other institutions together just closed the biggest IPP in Africa so far, the independent power producer. That's Nachtigal, the hydropower plant, $1.2 billion of privately funded and managed infrastructure. That's a big deal, especially in a country like Cameroon, in which you would have, you feel the conditions are still, this is still early to take that step, but it was absolutely possible. It took a long time to work together on all sides, but they have delivered a really state-of-the-art structure, which I think is going to withstand the kind of pressures that we've seen in Nigeria.
We're just going to take a short break at this point, and we'll come back and continue our conversation. I've been speaking to Peter Lankes, he's the IFC's Vice President for Economics and Private Sector. If you're just joining us, Peter Lankes, IFC's Vice President for Economics and Private Sector Development, is our guest today on Beyond Markets, and we're exploring how to maximize finance for development. Hans, thank you for your time so far.
Thank you.
You were talking earlier about those instruments, because I was asking you, what will be perhaps the new features, even though it's something that the World Bank has been doing before, but just the newer features of this maximizing finance for development. Talk to us about the instruments, specifically what those instruments are and the kind of impact you're expecting them to have.
Good. Yes. So one instrument is to have a proper diagnostic of what is affecting the private sector, and we have been rolling out diagnostics in now some 35 countries, looking sector by sector.
Across the globe?
Across the globe. Okay. But about half of that in Africa, because Africa is our priority. It's the priority of the World Bank Group. In fact, this is where we have to make development work, and that's why we focus on it. So we have these diagnostic tools which we developed together with our colleagues from the World Bank. So it's a public-private look at what it is that's holding up investment in different sectors of the economy. And building on that, we then have action plans, we have strategies. Now, this is, as I mentioned earlier, it's not that these things haven't happened in the past, but now they are happening in a much more systematic manner. Secondly, we have put in place mobilization tools. We know that there is a lot of private capital that can be invested, but that doesn't find its way into African infrastructure. Yeah? So how do we bring that capital to finance African infrastructure from institutional investors? And we've all heard about the numbers. There's probably about $250 trillion worth of institutional capital, one way or another, sitting in different financial assets in advanced economies. If we can get a fraction of that to move into infrastructure in developing countries, it will make a huge difference. We have built a syndications platform
Okay.
for institutional capital. It's called the MCPP, the Managed Co-Lending Portfolio Platform.
Okay.
And with that, we have attracted by now some $7 billion worth of funding from insurance companies, pension funds, and other institutional investors for whom otherwise this is considered too risky. How have we done that? We have built in some risk mitigation into this co-lending arrangement, where IFC would take a larger share of the risk. Sometimes other partners are taking a share of the risk, and that then de-risks what these institutional investors have to do. And they have their fiduciary duties towards their clients, so they need highly rated investments, and that's what we have achieved. They invest automatically some share into projects that IFC prepares. Then we have de-risking tools at the project level. And those are directed especially at the least developed environments. You're familiar with IDA?
Yes.
So IDA is this concessional arm of the World Bank. IDA is a very large amount of funding. Over 3 years, the current IDA period, over 3 years, has $75 billion available for the poorest countries in the world. That has traditionally all gone into public sector. Yeah? We have, for the first time in this IDA cycle, we have an allocation from that, which is available to provide risk mitigation for private sector projects. And we are utilizing that now with a very rapidly growing pipeline in the work that IFC is doing. So that makes it possible to take risks that otherwise would not be appropriate to take for commercial investors or for market-based investors like the IFC. So those are three types of tools that we are utilizing. But perhaps the most important is the fact that we approach, and I think this is something which more and more institutions are beginning to do. We approach the private investment problem as a sector problem, rather than looking at it from a transactions by transactions basis.
Okay.
We look at what it is that has to happen at the sector level, say the power sector,
Okay.
in order to open the doors for private investment. Let's not try to solve things incrementally. Let's do it on a sector basis.
So how long has this been going on now? And I'm just thinking about the impact. I mean, in terms of how you would be, or you are already measuring the impact.
So the strategy in the World Bank Group has been in place for 2.5 years now. And we are measuring impact. So we have actually, as part of the strategy, also put in place a new impact measurement tool at the IFC, which takes a project from well before the decision point and tries to anticipate the impact that a project might have, describe it, formulate it in a way that it becomes monitorable,
Okay.
and then follows the project over time. Now, the history of that is still fairly short, but we are seeing, at least on an ex ante, on a pre-decision point basis, how this is helping us direct funding towards projects where we get the biggest bang for the buck, because we can have an impact beyond the project itself by combining forces, as I described, with the bank and others.
Now, at the heart of all of this, and for the World Bank, it's all about meeting the Sustainable Development Goals. I mean, that that expires, or there's a 2030 deadline. We're about 11 years away from that. And I was just looking at some statistics from the World Bank. The cost of meeting, for instance, cost of meeting Sustainable Development Goals is $4.5 trillion. That's spending. It would require spending of $4.5 trillion every year, but there's still currently a $2.5 trillion gap. And obviously, all fingers still point to the private, unlocking more capital from the private sector. Would you say that 2.5 years later, with this approach, are we moving the needle when you look 11 years from now to 2030, how much traction do you think, what will be said in terms of how much capital we've been able to, to get, and how differently the private sector now feel about, unlocking more of this capital?
Yes, so the numbers that you're quoting, those are actually UN, United Nations numbers, which have sort of established the orders of magnitude. We all know it's incredibly difficult to measure these things, but it's sort of a useful point of reference. On the basis of those numbers, we formulated the motto of billions to trillions. This has been something guiding the World Bank Group and other parts of the international community. How do we move from the approach that has been billions, even hundreds of billions in development finance, into getting the private sector to provide the trillions, because the public sector is not going to provide the trillions. I'm afraid we have not made much progress on that trajectory yet. So we have put in place conditions like the ones that I've described, and we would hope that this is going to have increasing depth and increasing impact, and that we will eventually get the traction necessary. But for the time being, the numbers don't show that. In the World Bank Group, yes, we have been stepping up. We have been stepping up in Africa. We have been stepping up in the poorer countries. But we're a long way from where we want to go. IFC wants to reach an annual volume of financing of 50 billion by 2030.
Are you on track? Are you?
We are between 20 and 24 billion right now, including what we call direct mobilization. So there's a long way to go there. The same is true for many other institutions. And if we look at the overall numbers, the private investment in infrastructure, for instance, in emerging markets, has not moved up. In some cases, it has moved down lately. And that, of course, has to do with global conditions as much as with the particular efforts that we're making in developing countries. So we need to have a supportive global economic environment in order to get there as well. If there's a general risk aversion because the global economy is stuttering, we are not going to get sort of a...
And that's a very good point you make there, because, at the end of the day, we're all operating in this global economy where, we see shocks from time to time. Currently, obviously, the US-China trade spat, this nationalism that we keep seeing in pockets across the globe. But away from that, what I also understand about this, the Maximizing Finance for Development, is that the World Bank is not just only looking to unlock that private capital into infrastructure, but also investing in people. They believe that that can also bring about bigger impact. Can you just share some insight on that?
Yes, no, human capital is absolutely central to development, and we have a big problem. Human capital is far from where it should be. There's much more potential in people than we are realizing. Now this is so far driven primarily by the public sector, the investments in education, investments in health. The private sector is playing a role. It is our view at the IFC that the private sector could play a much bigger role in these areas. For instance, through technology-driven solutions, there are very good ways of partnering up the public and the private sector in both the health and in the education areas. These are areas in which there are often concerns, whether if you bring in or you rely too much on the private sector, whether you make it more difficult for poorer parts of the population to participate, whether you're beginning to exclude them. We have to find ways around that. Here in Nigeria, there is a very interesting experiment that has taken place in Edo State, where there is a combination of public-driven objectives with contracting certain parts of the primary education to private sector providers, in particular the use of technology for improving the quality of education. And it's a very promising start, which I would like to build on.
Okay. Hans, we're going to have to leave it there. Thank you so much for talking to us today. We appreciate your time on the show.
Thank you very much.
I've been speaking to Hans Peter Lankes. He's the IFC's Vice President for Economics and Private Sector Development. Well, that's our show for today. Thank you so much for being a part of it. Remember, you can watch the show. You can catch all previous episodes of Beyond Markets on our website. That's CNBCAfrica.com. You can also stay engaged with the hashtag Beyond Markets, and you can send tweets to my Twitter handle too. It's at Esther O. Awuni. For myself and the team, it's bye for now.